Another type of pension plan that you could get is what we call a group RSP, basically. So here, what we're really saying is that it's really identical to typical RSPs, individual, except that now we are grouped. So usually this is a plan that the employer provides for you. So this is a situation really where instead of you putting in $10,000 into a plan and somebody else puts in $10,000 in a different plan, and all that. So you don't really have a great deal, a place you can actually invest your money because you don't have enough money, you might say. But if we group it together, so if there's 10 of us, let's say, and we all put in $10,000, now we've got $100,000. So there's something we could do. In other words, by grouping our funds together, we may have a better chance of earning a better return on our money rather than trying to do it all on an individual basis. Okay. And once again, because it is an RSP, you have that flexibility in terms of where do you want your money invested, depending on your risk tolerance, things of that nature there. Also remember, because it is an RSP, you still have the same restrictions in terms of 18% of your earned income to a maximum of, and so on and so forth. So the RSP portion has not lost its nature. It still is an RSP. All we're saying is that rather than buying an individual RSP, why don't we all get together, basically, and pool our resources and everything, and that way hopefully we'll all make more money and also, but the restrictions are still the same. Okay, nothing changed. Okay. So the idea also is that because we are pooling all of our resources, theoretically the fees should be lower. So the management fees and everything else, because we have a much larger pool of money, so we can spread the cost, you might say, over a much larger group of people and everything, versus I have to charge you as an individual because you're the only client I've got, so to speak, but when I have a pool. So so you get what's called an economy of scale. So you can sort of spread out the fee to a wider group, and so therefore the fees are much, much lower. Okay. The big one in my mind has always been payroll savings. In other words, the employer has agreed that they will deduct from your paycheck whatever it is that you decide to put into your into your pension plan. So as they say, if you don't see it, you won't spend it. Okay, so it's already automatically deducted from your paycheck. It's money you don't see, and before you know it, you'll be quite surprised how fast these things can grow as well. Okay, so it is sort of a payroll savings or payroll deduction or forced savings, however you want to do it. In some cases, even most employers, and we certainly encourage employers that they should also make a contribution to your group RSP. Again, as an incentive. So they put in, let's say, $1,000 or something every year for you, and then you put in the rest of your money yourself. So as an incentive, usually these things work best when an employer actually makes it. Now, sort of not only do they make it available to you, but they also contribute on your behalf as well. There seems to be a much, much higher uptake if the employer actually has put in some money on the table as well. So that's another sort of benefit that you can have. Okay. There are also no restrictions on eligibility. So this is not a situation, for example, if you remember with the defined benefit pension plan, we said, you got 2 years. Before the first 2 years, it doesn't vest to you or whatever, unless I make other provisions. Okay, here it's yours. You start right from day one, basically. So you don't have time limits or anything, and you don't have restrictions as to who can participate, who cannot participate, and all that. Everybody can participate at whatever level that they wish to participate in. Okay. Also, the money itself is of course not locked in. So basically, that means that you can take your money out whenever you want. So if you decide that you're leaving the company, you want to cash out, whatever it is, that's certainly your privilege. In other words, the privileges and rights and privileges that you have on an RSP continue on. It's nothing changes. So therefore, because that money is not locked in, you decide that you want to withdraw some money or you want to collapse the plan or whatever it is, you're certainly welcome to do that. We don't encourage that, of course, but that's something you can do. So your RSP, like I said, could be cashed in or whatever, or you can convert that into a RRIF. At some point in the future, age 71 maximum, basically you decide, okay, I'm leaving employment, I'm 60 years old, I'm 65 years old, I'm leaving employment, I want to take my RSP now and I want to convert that over into some kind of a deaccumulation plan. So therefore I buy a raise to retirement income fund, so I start getting a paycheck from the annuity holder, basically. I can cash it in if I want to, because then it's not locked in, remember, so I can just basically cash it in and walk away. It's all supportable. Let's say that I decide that I'm going to leave the employment. Okay, I'm leaving the employment. I can take that with me, and now it becomes an individual RRSP, just like I had before. So before I was part of the pool. Now I'm no longer part of the pool, but it's still my RRSP. I can basically take that with me, and once again do whatever I want to do it. If I want to move that over to another company that has also a pooled RRSP, I can simply add mine to that particular pool. So it is totally portable. So lots and lots of flexibility when it comes to a group RRSP. But remember that the nature of the RRSP remains the same. So it's not that you've lost anything here. All we're doing really is we're pooling the resources, get an economy of scale. Hopefully the employer put some money in it as well. And it'll just be obviously a better plan for everybody. One of the things we have to look at in terms of an RRSP or a RIF is what happens if the individual dies. Okay, at some point we all die, as they say. And let's say you've got RRSP money sitting there, or you've got RIF money sitting in there, whatever. So you're in your 70s, let's say, or you're in your 60s or whatever. But you've got RRSP money, you've got RIF money, and you pass away. Okay, so you have a named beneficiary, and therefore there are going to be some tax implications and all that. If you leave the monies directly to your estate, in other words, everything is the beneficiary of your money is the estate, then the whole thing will be 100% taxed. It's really as simple as that. Okay, it's that you're deemed to have disposed of all your worldly assets at your marginal tax rate the day before you died, whatever, that kind of stuff there. So therefore, if you leave your beneficiaries your estate, then all that money is basically taxed at the highest marginal rate. And so you can see that not advisable basically to do that, because there are other options available to you. Okay, but one of the reasons why you have a named beneficiary, so your spouse, whatever, as a named beneficiary, is to avoid probate. Because if you leave it to the estate, not only will creditors could possibly attack that money. Not only will it be fully taxed, but it also forms part of your estate, which means that there will be probate taxes on that as well. And so there are some serious implications here of leaving money to your estate. So a way to avoid all these things here is name your spouse as the beneficiary. So in other words, your spouse takes a rollover. So there is, in law, there is what we refer to as spousal rollover. Now I draw your attention to the fact that it is spousal rollover. So it's not children rollover. There are a couple of exemptions to that in a moment, but basically it's not sibling rollover and all that. So in other words, the rollover provision is only between spouses, whether they be legally married or common law spouses, doesn't matter. They're still a spouse, and therefore it's simply a rollover. When you roll over money to a spouse, it is exactly that, rolled over. And so therefore there is no disposition, there is no tax implication. So the word rollover is very important, because without that word, then it's considered disposition. If it's disposed of, then you've got a tax implication right away, okay? But if you roll over the money to a spouse, then that spouse basically takes over where you left off. So that spouse basically enters into your shoes, you might say, and wherever you were in terms of the adjusted cost base and all that, they assume the exact same position. So on a spousal rollover, you are deferring your taxes further down the line when that spouse passes away, herself or himself or whatever it is. So the idea is not you're actually avoiding the tax. All you're saying is by doing a spousal rollover, you're deferring the tax to a later date. That's all. That's all that's happening. But in the meantime, at least it saves you substantial sums of money. I said to you also that there are some exceptions to what I've just said, okay, in terms of the rollover, okay. If you have a child that's younger than age 18, so 14 years old or whatever it is, and you've got an RRSP or a RIF, you can actually roll that over to your younger child. What will happen is the trustee, whoever's taking care of your child, the guardian, has the rights to buy an annuity to age 18. So so your child is 14, let's say, and you buy a 4-year deferred annuity, you might say, to age 18. Then at age 18, the money gets released. And then, of course, taxed accordingly, and so on and so forth, okay? So there is that rollover provision if your child is younger than 18. So once again, you've avoided the tax at that moment, but you haven't entirely avoided because all you're doing is deferring the tax to a later date. So when that child reaches age of majority, in this case age 18, then that child will be recipient of those funds, and of course will have to pay tax at that point. But there is a deferral. Okay, there is a deferral. Right? If they're 18 or over and they are mentally or physically disabled, and you roll your money over because they are still dependents of yours because of the mental or physical disability, they are technically still basically dependent on you. Okay, you can also have a rollover for that. So what they'll do there is they will buy an annuity basically once again for that child, that disabled child, depending on that child's age and everything else. And once again, the taxes will be paid on an ongoing basis. So you haven't again avoided the tax, but you simply basically have deferred the tax. So that is two ways basically that outside of the spouse, basically two ways that you could defer the tax is if your child is younger than 18 or your child is over age 18 but are mentally and physically disabled, then you can do that. When I say child, I should also mention that it also applies to grandchild. So if I'm in my 70s and I have an 18-year-old grandchild, a 14-year-old grandchild, I can leave my RSP, sort of my RIFs, whatever, over to my grandchild because they're younger than 18, or my grandchild is a disabled child. Okay, I can roll over my RIF money or my RSP money upon my death. I can roll that over to that disabled child. So the same way as a child, a grandchild qualifies for the same thing as well. Okay, there are two more uses of RRSPs, and we will talk about that in a moment.